Ever feel like your finances are on a roller coaster? Up 1 minute, down the next? Yeah, me too. That's why so many people are turning to financial apps these days. From budgeting to investing, there seems to be an app for everything. But what about getting quick cash when you need it most? Enter Branch, the lending app promising fast and easy loans. Sounds like a lifesaver, right? Well, hold on a sec. While Branch can be a convenient option, there might be some downsides you need to consider before diving in. So, today we're taking a deep dive into the Branch app. We'll explore how it works, the good, the bad, and the ugly, so you can decide if it's the right fit for you. Let's get started. First things first, Branch offers different loan options depending on your location. Generally, it's known for short-term, single-payment loans. You borrow a specific amount, and on your next payday, or a set date, the entire amount plus interest is automatically deducted from your bank account. Sounds straightforward, right? There's definitely an appeal to that. But here's where things get interesting. Disadvantage number 1, interest rates can bite. Branch prides itself on transparency, which is great. You'll see the interest rate up front before you take out a loan. But here's the catch, these rates can be pretty high, especially compared to traditional bank loans. We're talking double digits in some cases. Let's break it down with an example. Say you need a quick 5,000 naira, $12.50, conversion rate as of June 21st, 2024, to cover an unexpected expense. Branch might offer you a repayment term of 2 weeks with an interest rate of 20%. That means you'd end up paying back 6,000 naira, $15. Now, 1,000 naira, $2.50, might not seem like a big deal. But what if you need to borrow more often? Those interest charges can add up quickly, pushing you further into a cycle of debt. Disadvantage number 2, the debt trap is real. The convenience of Branch can be a double-edged sword. Because it's so easy to access small loans, you might find yourself relying on them too much. That quick fix for one expense can snowball into multiple loans, making it even harder to manage your finances in the long run. Here's a tip. Before you hit that borrow button, take a step back. Is there another way to handle this expense? Can you cut back somewhere else in your budget? Remember, a loan is just that, borrowed money that needs to be repaid with interest. Disadvantage number 3, not for building credit. If you're looking to build your credit score, Branch might not be the answer. Unlike traditional loans from banks, your Branch activity isn't typically reported to credit bureaus. So, while timely repayments won't necessarily hurt your credit, they also won't help you build it. Alternative solutions. Alright, so Branch might not be the perfect solution for everyone. But what are some alternatives? Talk to a friend or family member. This can be a tough conversation, but sometimes all you need is a small, interest-free loan to get back on track. Negotiate a payment plan. If you're facing a bill you can't pay up front, reach out to the creditor and see if you can work out a payment plan. You might be surprised at their willingness to find a solution. Consider a credit union. Credit unions are member-owned financial institutions that often offer lower interest rates on loans than traditional banks. Branch can be a helpful tool in a pinch. But remember, it's important to be aware of the potential drawbacks before you borrow. High interest rates and the risk of falling into a debt trap are real concerns. Final takeaway? Use Branch responsibly and explore alternative solutions whenever possible. With that said, thanks for watching and until next time.